Also looming over us and very connected is today's Fed meeting. Of course, the Federal Reserve expected, as we know, to raise rates by 50 basis points. Our next guest thinks that'll be it. That might be the last hike we see for a while. He called it a contrarian take, the most contrarian take in a recent tweet. Yeah, I think that's accurate. Josh Wolfe is with us now, Lux Capital co-founder and managing partner. Josh, good to see you. Lay out your case here. Why would this be sort of a one and done or one and done for now from the Fed?
You know, it's interesting. The last few segments you had, you were talking about ISM is down. You were talking about oil prices are up. Consumer discretionary is down. I actually think consumer discretionary is going to continue to go down, not so much for rising prices that people can't afford it, but demand was pulled forward during COVID, and people don't need their extra Peloton. They don't need more clothes. They don't need another computer. They basically pulled forward years of demand. Consumer staples are getting crushed. And these are the poorest people in the country who are the most hurting. And they've got food and fuel prices that are rocketing. And I think we've got a time where you've got, 11.5 million open jobs. It looks like we have full employment. The Fed's double mandate of price stability and full employment means that, okay, they're going to, try to attack inflation. But I think this is mostly a supply issue. I think this is mostly an issue also of a transferred wealth effect. For the past generation, you've had this Goldilocks expectation of soft landings every time the Fed gets involved. And mostly, even though they're supposed to manage price stability and employment, they've been managing the stock market. And the reality is they transmit this wealth effect. It adds collateral to borrowing and margin accounts. Companies and CEOs and boards are buying stocks back, and they're doing it at ever record valuations. All of this distorts valuations horribly. Everyone has had this Fed put mindset for the past decade, just buy the dip. And so basically the cost of capital was too low for too long. And the lower the cost of capital in my business, we were beneficiaries of this. So I'm being really intellectually honest here that, you'd have these 20-year far out fanciful ideas that basically became these 20-month frenzied projects. And now you see this sort of excess and exaggeration and the absurdity and the frauds that are starting to come out in the tech world. And you can see this, by the way, in the TV shows, right? You look at the Uber show, Super Pumped, and the WeWork, We Crashed, and then the Theranos story in The Dropout. Those were all excess, exaggeration, and absurdity. So right now you've got the Fed basically trying to land a plane. And the risk of oversteering, where you've got passengers in the back, some of whom are suffering from these consumer staples, and they need painkillers. They need rubbing alcohol to heal their wounds. And it's sort of a mixed metaphor here, but they need low rates. And they got to make mortgage payments, and they're taking out more credit, and they got to pay for basic food and fuel. And then you've got others on the plane who are basically partying, and they want the pills and the alcohol just for continued speculating. And so you have a situation where the Fed was too slow to act when the economy was growing, and now it risks being too fast to act when the economy is slowing. Okay,
and so for a Fed that was continually leaning into transitory for quite some time to the point of detriment, and then acknowledged later on how much that actually may have hit on their perception. If they did do a one and done, as you mentioned, how much would they continue to have to be concerned about that perception of how the Fed is navigating right now?
Well, part of this is how much does the Fed care about its credibility? And some of this, we're finding out maybe Powell delayed some of the views that inflation wasn't transitory for political reasons. That aside, yes, 6 months ago in November, the Fed finally says, okay, inflation isn't transitory. It takes another 4 months from that point, just in March, to get its first quarter point hike, and then paring back the $40 billion of monthly mortgages. Now, I expect you're going to see 50 basis points today. Could you see something in June, maybe another 25 points? Maybe. But I really think that the pressure is going to be on between political pressure and just actual, even though we have lagging data, a really hit hard suffering consumer. You add on top of that quantitative tightening that's going to start in June of $90 billion a month between mortgage and other debt that they're pulling back. And so I think the market in anticipation has rightly been guided and has already taken rates up. We now got the 10-year at 3, even though we've got a flat curve across the board. The 2, 5, and 10-year are all approaching that. So the big question is, does the Fed keep going and then tip us further into recession? And I think they got a lot of criticism and will get a lot of criticism for not acting soon enough. And I think the new criticism will be that they acted too fast and too hard when all the signs are that we're about to hit a really hard recession.
Josh, as you mentioned, you're in the VC world. You got a lot of folks on the other side of this trade, as you well know, right? As you called it, it's a contrarian take. And most folks are very much in the other direction, that we're going to see multiple 50 basis point increases this year. Some folks even calling for a 75 basis point rise, at least one of them. If the Fed does what you're suggesting, you would then presumably get a tightening of financial conditions, which could then exacerbate some of the issues that you're talking about. So I wonder if the Fed is really going to weigh the risks in the direction that you're talking about.
Look, nobody has a perfect crystal ball. We'll know today at 2:00. We'll know again in June. My view is the conditions for tightening are already happening. You've got bond and stock market investors that are dumping, right? And so you're seeing a correlation between fixed income and equity, not usually correlated, just decline. People are basically saying this is not a time to be greedy and lean in and speculate and try to make money. You're going to have a whole camp of people that are basically like, now is a time to not lose money. So if we went from FOMO, fear of missing out, and then I coined this term SOBs, shame of being suckered. You didn't want to do something really stupid. I think you've got pull now, which is going to be either the pleasure or the pride of losing less.
SOBs, I like that. I will be using that somewhere at some point this week. Josh Wolfe, co-founder and managing partner of Lux Capital. Always good to see you.